All right. The next video, which I'm doing now, courtesy of Zero Hedge, caught my eye, caught my attention. The last two times PE multiples expanded this much, the result was a historic crash in the markets. Now, what is PE? PE is is short for the ratio of a company's share price to its per share earnings. As the name implies, to calculate the PE, you simply take the current stock price of a company and divide it by its earnings per share. So that's the PE or P/E ratio, market value per share. So the last time these multiples expanded this much, the result was a historic crash. It's not just former Fed economists who are getting worried. So is Goldman, as in Goldman Sachs, vampire squid. And I just want to say something on that topic for a second. That's off topic. And this is a little scary. Hopefully it's nothing, but, kind of bothersome. Donald Trump's not vice president, the head who's going to be nominated Treasury Secretary under him is a former Goldman Sachs guy. He's currently heading Donald Trump's financial things for his campaign, head of his finances or whatever that term is. Donald, what's going on, buddy? But maybe, he worked there for a little while. It was many years ago. Yeah, maybe there's, he couldn't, maybe, he was a good guy, couldn't fit in with the club and left, I guess we could have our hopes up. But then again, I am Realist News and I don't smoke hopium. So that kind of bothered me. Continuing on, though. As we wrote last weekend, with stock valuations at extremes, Goldman's clients are asking just one question. Namely, how much longer can the rally continue? This followed another Goldman warning from 2 weeks ago, where, as we noted before, Goldman warns of a sharp plunge in stocks in next few months. Imagine that. Who knows, maybe Goldman will be right and the market will plunge. It certainly isn't trading at all-time highs and 25 times gap or GAAP multiples on fundamentals. But for now, those who heeded Goldman's warning and traded ahead of a 10% pullback have gotten crushed. We've had all-time record highs here, haven't we? So has Goldman's chief equity strategist, David Kostin, finally thrown in the towel? Not yet. In fact, Kostin appears to be doubling down. And as he observes correctly overnight, the one sole reason behind the market rally in recent years, clearly not earnings growth, as we wrote earlier, namely multiple expansion, is now substantially overdone. And not just that, as Kostin points out, there have been only 2 times in history when the PE multiple has expanded as much as 75% or more as it has in the current cycle, 1984 to 1987, we remember that one, in 1994 and also in 1994, both ended with historic crashes, and to wit, the current PE expansion cycle is now one of the largest in history. Since September 2011, S&P 500 forward PE has grown by 75% from 10 times to 18 times. This expansion has only been surpassed twice since 1976, when the multiple rose by 111% from 1984 to 87, ending with the 22% Black Monday collapse, and by 115% from 1994 to 1999. I think that's what he meant in the other one, not 94 to 94. 94 to 99, tech bubble, of course, and that's what he says, ending with a tech bubble burst. During the 9 previous PE expansion cycles, the multiple typically climbed by 50%. Thanks, David. We get it. It's going to end very badly. Just maybe tell your friend Bill Dudley to stop pushing it ever higher and ensuring the resulting crash will be that much worse. Maybe. And speaking of that, with the market continuing to levitate on even more multiple expansion, or is a sharp drop just around the corner? According to Goldman, the answer is the latter. Last week's commentary highlighted several reasons why we believe the current 75% PE multiple expansion cycle is unlikely to continue. Number one, already extended PE multiple of 18 times represents the 88th percentile of historical valuation. Number two, lack of earnings growth, with full year 2016 adjusted EPS expected to be flat for the third consecutive year, operating EPS up 9%. Number three, downside EPS risk as low interest rates boost pension obligations and constrain financials profits. Number four, rising wage inflation that will pressure current near record high margins. Number five, the prospect of a more hawkish Fed than the market now expects. We maintain our S&P 500 year-end 2016 price target of 2,100, although 5 to 10% near-term downside risk remains high. Instead of ending it on an apocalyptic note, here is Goldman with a useful detour at the most topical issue right now, the Fed model. The impact of low interest rates on equity valuations is a hotly debated topic among investors. The Fed model compares the gap between the earnings yields of equities, 5.7%, and the 10-year Treasury, U.S. Treasury yield, 1.6%. The current yield gap equals 415 basis points, slightly below its 10-year average of 440 basis points, but well above its 40-year average of 250. The Fed model paints a similar picture for S&P 500 valuation when using Treasuries, TIPS, or BBB yields. A common criticism of the traditional Fed model is that it compares equity returns in real terms to Treasury yields in nominal terms. On inflation-adjusted time series such as Treasury Inflation Protection Securities, or TIPS, may arguably provide a more accurate representation of the yield gap. However, the yield gap relative to history is little changed when using TIPS. The current yield gap using TIPS equals 560 basis points, slightly below the 10-year average of 640. Similarly, some investors prefer to use BBB corporate bond yields instead of 10-year U.S. Treasuries to represent the cost of capital faced by firms. The current gap using BBB yields equals 240 basis points, which is in line with the 10-year average of 235 basis points. As we noted last week, the yield gap may narrow from either direction, such as, rising bond yield or falling earnings yield, which means higher PE multiple. However, the yield gap has already fallen by 93 basis points this cycle, from a record 807 in 2011 to 415 basis points. Assuming the 10-year Treasury yield rises to 3.1% and the earnings yield remains unchanged at 5.7%, the yield gap would be equal to long-term average of 250 basis points and imply an S&P 500 level of 2230 or 2,230, 3% above the current level, by the way. Conversely, if the bond yield remains static at 1.5%, mean reversion of the yield gap would require the earnings yield to fall to 4%, equivalent to a PE multiple of 25 times, and an index level of 3,070, up 42%. A more modest bull case would involve a compression of the yield gap to 350 basis points, with interest rates remaining at 1.8%, implying a PE of 19 times and an S&P 500 level of 2,220, 7% above the current level. All this is nonsense speak from Goldman Sachs. When someone reads this, you say to yourself, what the hell did I just read? What in the hell am I reading? What does this mean? What's the stock market? You get nothing out of this ultimately. The market's going to do what the club wants it to do. And the market's been wanting to dive for a long time, and it keeps being propped up by the club, propped up more by the club, propped up more by the club. This is exactly to the T what Lindsey Williams said would happen several years ago. They're going to pump that market up. And when it can't go up any higher, it's going to go even higher. And when it can't go higher than again, it's going to keep going higher. And when there's no reason at all for this thing to go higher, it's going to go higher again. Why did he? And he said, you know why they're doing that? My elite friend told me, is because they want to pull every last sucker, at as many as possible, back into this market, so that when they pull the number on them, most everybody is crushed. That's their plan. So Zero Hedge sums this up at the end. What Goldman does not touch on, however, is the circular nature of fund flows, where if bond yields do surge, as some are warning may happen soon on fears of an inflationary spike, it will lead to not only a rates VAR shock and massive MTM losses as big as $2.5 trillion, but also to downstream liquidation in equities, which in turn will lead to a flight to safety right back into bonds, and so on until something finally does break. When I read this and I hear all this crap, PE multipliers and, was that last, all this, triple B yields up and, tips, and this is nonsense. All of this is nothing but nonsense. None of this matters in a rigged market. Yeah, well, we live in a capitalistic society. We talk about this is a capitalistic market, Chase Nip, but no, capitalistic markets aren't rigged. Gold and silver prices aren't rigged. Commodities, oil, aren't rigged. Stock markets themselves, like ours, S&P, Dow Jones, aren't rigged to go higher. When bad news comes, markets rally. Good news comes, markets rally. Oh, Brexit, oh, bad news in the EU. Up, America, markets rally. Oh, wait a minute. That's right. They want every last sucker to be sucked back in the market. So all you people in the UK zone, EU zone, worried about your investments and retirement, America's looking great. I think I'm going to go invest over there. Oh, you're going to. And you'll be buying our debt for a while. Not too much longer, because we're printing it out of control. We're borrowing out of control. And someone I'm going to end this video by just saying this. Someone on my wife's Facebook page posts a chart today, a little small chart. And it had the presidents going back to Ronald Reagan in forward, and said percentage in which the debt ceiling went up by president. So Ronald Reagan, 189%, he's king of it. I said, no. He's king of it? Where the hell's Barack? Barack is last place? What in the hell? What is this? Oh, chart only goes to 2011. So you chose to put Barack Obama on a chart when he, was only president for basically 2 years, right? He walks in 2009, 10, 11. So he has a 10 trillion and it goes to 12 trillion. That's $2 trillion. Okay, there's his percentage. He's way down here. Yes, Ronald Reagan did raise the debt ceiling. Again, under Congress. Not the president doesn't raise it. The Congress does. The president just signs off like they always do. And I don't play the left, right, Democrat, Republican. None of that means that's meaningless to me. But roughly, and I know this, roughly, the debt in 1980, 81-ish was around $1 trillion. So essentially what they're saying, by his end of his term, which is, I believe he had an 8-year term, it was up 189%. So, what is that, $3 trillion or so, roughly? If it was 200% higher, $1 trillion, another trillion, another trillion. Man, that's a lot of money, right? 1 trillion to 3 trillion, holy crap, 189%. However, hold on. Barack Obama, we're in wherever they got that garbage chart from. How about looking at it after Barack Obama's term is over? We're almost there. We got 6 more months, but we're nearing 20 trillion. When he took over, it was technically 9 point something trillion when he really took over. But, Bush was walking out, he's walking in, 10 trillion, whatever. He's doubled the debt. So, but he's still only 100%. Ronald Reagan was 189%. Ronald Reagan, 1 trillion to 3 trillion. Barack Obama, 10 trillion to 20 trillion. Ronald Reagan adds 2 trillion to the debt. Barack Obama adds 10 trillion to the debt. But on a percentage basis, it looks as if Ronald Reagan was the worst one. However, again, people want to, well, as the president, under president, hold on. Did Ronald Reagan cause the gold price to go to $850 back then and silver $50? And then we have this lead up stock market all-time high, 1987, boom, crash. All these economic problems, the savings and loan crisis, bailout. Can that really be pointed to the president? You might argue, well, then why are you pointing it to Obama? And you are absolutely right. The president is just the conductor of the train. Every 4 years, sometimes 8 years, he's replaced. New conductor takes over. Toots the whistle, waves to everybody. Yeah, I'm the big cheese, dude. Yeah. Got his entourage all the way down in the cars behind him. No one seems to see, wait a minute, you're in charge of the train, you're the conductor, but you're driving down predetermined tracks to somewhere that's already been laid out. That's a Big 10-4. So it seems to me it doesn't matter who the conductor is of the train. Bingo. Congratulations, you nailed it. It doesn't matter who the conductor of the train. It doesn't matter who the president is. Democrat, Republican, good economy, bad economy, boom and bust cycle, the business cycle. It means nothing. It only matters to the sheeple who don't pay attention, who briefly look over, what's the news today? Oh, yeah, President, yeah, we need more jobs. Yeah, that's why I voted for you. All right, back, where was I? Did you follow your so-called president leader to see if he followed through on that? Did you see what his voting record is prior to voting for him? You see who he's related to? No one cares. You just blue colors, okay? Good vote. Okay, gotcha. You're a blue, I'm a red. We hate the Bloods and the Crips, the Dems and the Repub. Meaningless. The markets are going to crash when the club is good and ready. And it appears, now you will recall, last year, and I knew then, we were all expecting, hey, September 23rd, 24th, this big date, remember that? It was all in the movies and everything. And we had kind of a mini downward market movement. And certainly not something to call a crash. We did start off January 2016 as one of the worst ever for markets in 2016. But it wasn't this. Where was the big crash we're all waiting for? What happened? And I said, guys, I can see something happening here that I think happened, I know happened, the last election with Barack Obama when he first came in. I said, I think they might try to do this again. It just makes sense. Here's why. When George Bush was leaving office, so Barack could take over, the Congress swiftly passed the debt ceiling increase. Boop. You can't get mad at Bush. He's walking out the door. The door's practically being shut on him. Can't blame it on him. And the new guy, he didn't even give him a chance at it. He's walking in the front door. Raise the debt ceiling. Can't blame anybody. And what did we have in 2008 as we're looking at these two candidates and Barack's, out doing his thing? We have this market crash, September, October timeframe, right? Can you blame Bush at the very, very end of his... No. He held it together for all that time. 8 years? Come on. The next guy, we don't even know whose it is yet because it's still September, October. We think it might be Barack, but it could be, McCain or whoever. We don't know. Can't blame anyone there. They're not even picked yet. See how that worked? And then whoever gets it, I'll fix the problem. And that was, remember everything he said he was going to do. I will urge you to go to YouTube and type in Obama campaign speech 2008 and listen to this man speak, teleprompter included, because if you find the ones where his teleprompter turns off, you're not going to like that. It just goes dead. You can hear crickets. But nonetheless, when he's speaking, you hear what he's saying, I'm going to fix this in Wall Street, and this. You'd have been a fool not to vote for that man. You'd have been a fool. He said everything that was wrong. It worked great the way he said it. I mean, this guy, who is he? He's a one-term senator. We don't know this guy. But then people start putting some pieces together. Hold on, he's related to this one. Okay, he's related to the communist guy. Oh, man. Nothing. And now we got him. And Wall Street has never made more money, ever, than in the last 8 years. Bailout, 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 money, free lending window from the Fed. We give us as much as we want, then we lend it out, take a little bit of the interest that we made on lending it out, and then pay the Fed back. Could you imagine? I'm the Fed, right? I'm your friend, the Fed friend of yours, and you're all my club members. You're my buddies. And you're just average Americans. I mean, super average. Like, you live maybe paycheck to paycheck. Let's just call it even for everybody. You all live paycheck to paycheck. You don't have really anything in savings. For all intents and purposes, you are an insolvent bank yourself, okay? But I come along and I say, you know what? Guys, step into my office. Wow, we're fired? No, you're fired. You're part of the club. Come on in. I'm going to give you guys trillions of dollars split amongst yourselves. It'll cost you near zero interest rate. It'll be so close to zero, it'll practically be zero. Do what you want with the money. Lend it out 2, 3, 4, 5%, 6%, whatever you want. And then just pay us back this 0.25% back interest rate. So I essentially give you all trillions to split. You now can lend out hundreds and hundreds and hundreds of millions and billions, and then earn interest off that. Sure, you're going to have some deadbeat not paying this one, but you're going to have so many loans out there, it doesn't matter. And you could give them a decent deal, 4, 5, 6%, when it used to be 7, 8, 9, 10%. Well, give them a decent deal. Because even at 3%, I got the lowest mortgage rate on the face of the earth. What'd you get, dude? 3.5%. Damn. So the bank actually gets 3.25, not 3.5, 3.25, because they got to give the 0.25 to the Fed back. So they make 3.25, Fed gets 0.25, and they're loving life. But what if they made a 5% loan to somebody? You know, auto loan, some other loan, personal loan, whatever, credit cards. Oh, don't get me started on the credit cards. Let's go there for a second. 20%, 23%, 29%. I'm going to charge you, you schmuck American citizen, 23%. And you got great credit, by the way. And I'm going to take a quarter of that. So I'm going to take 22.75% interest, all mine, off this free money that I got, and lend it out to you again at 23. What you pay me back, I take a little 0.25% out and fling it over to the Fed. Talk about a conflict of interest. And if you get in hard times, you poor sap will repossess the item or foreclose if it's a house. Take your boat, take your whatever you got. You deadbeat. No one told you to get that loan out. Nobody forced you to get the loan. Oh, wait a minute. You can't live in a house for free? Oh, wait a minute. People don't have $200,000, $300,000 in cash in their pocket when they turn 18, 19, 20 and go out in the world to go buy a house? Oh, so you do have to get a loan. No one told you. Oh, so I can either get a loan and own something ultimately 30 years later, or I can pay rent the rest of my life owning nothing. And then when I retire, I'll have rent payment to make plus a crappy retirement. I won't be able to survive. So actually, yes, you do have to get a loan. Yes, they do make you get a loan. Because if you don't, you lose even worse. I am Jason at 4. Take care.